Someone has $1 million tax bill. How do they invest that into real estate to avoid paying any taxes? What do you do exactly?
So if you have $1 million tax bill, let's just say you're self-employed, what you could do is try to max out excess business loss limitations. You can invest in real estate, buy multifamily real estate or short-term real estate, as long as you're able to either one, qualify as a real estate professional, or two, show the IRS that you're running a short-term rental by the IRS's definition. If you're able to do one of these two things, then you can incorporate the strategy called the cost segregation study.
Real estate is definitely an amazing wealth building tool, not just because it gives you the opportunity to participate in an appreciating asset class and generate cash flow while doing it. It also gives you the opportunity to potentially get exposed to a variety of different tax reduction strategies. Now, the challenge with real estate is to understand that by default, real estate is considered to be a passive activity. If that real estate is being engaged in for the generation of rental income. Rental income by default is passive. Back in 1986, the passive activity loss rules came into effect, and that essentially means passive activities must be carved out and kept separate from non-passive, meaning your W-2 activity and your business activity, where you actually engage your time, effort, and energy to generate revenue. But real estate is very attractive, especially for those who are earning high 6 and 7 figures plus, because the depreciation expense is not necessarily something you actually experience. It's something that happens on paper, and those losses potentially, if you qualify for an exception to the passive activity loss rules, could really offset some significant taxable income on the non-passive side. But how do you do that? Well, there are two major exceptions to the passive activity loss rules. The first is the real estate professional status. This requires you to engage in the trade and/or business of real estate for at least 750 hours every calendar year. Now, not only that, it also has to be the majority of what you do. And the underlying real estate that you're engaged in, you must own at least 5% of it. You see, this is where it becomes pretty problematic for many tax filers. But the other exception is a little bit easier, even that's hard to say, but a little bit different to experience. That's called the short-term rental exception. In that exception, your tenants in your rental property, they're staying in that property on average for 7 days or less. And no one else can work in that particular business more than you. Again, not necessarily a deal breaker, but it is something that you need to be aware of. Now, if you're trying to figure out which strategy could potentially help you, you want to sit down with someone who actually knows how these systems work. So go ahead, drop the word apply, and let's see if it's me.